Hey everyone, hopefully having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, like I normally do, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in there, take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, findinghighvalue.com, where I dive deeper into all of these topics, subjects, looking for potential investment opportunities and sharing those opportunities with everyone in the community. We have question and answer sessions on the weekends. We've got one coming up at 5 p.m. Sunday, Mountain Time, where I answer your guys' questions. I also go through earnings conference calls. That's what a lot of the members like doing. And then you guys ask a bunch of different questions, and I dive deep into maybe macro environments, yield curves, anything. Basically, go over some of these macro environment, big picture things. So if that sounds interesting to you, definitely sign up. We have a coupon code special. So special is that code for savings on a monthly or yearly membership. So smart real estate bets. I do like this guy. I think he would approach problems similar to myself. At least that's what I would think. So I'm going to go through this real quick on this real estate debacle here. So Danielle DiMartini Booth, it says, why will this disconnect be rectified here? We got this disconnect. The cost to buy a home or investment property versus the cost to rent ratio. So let's go through it. It says, this is an interesting graphic that certainly raises an eyebrow, but it is an apples to oranges comparison in terms of affordability. Why? Because the vast majority of home buyers rely on a mortgage, and this graphic completely disregards the very important variable. Rent is a regular cash outflow that a tenant pays every month. There's an equivalent corresponding metric for a homeowner, their monthly mortgage payment. A comparison of how those costs have changed, still using 1987 as a baseline, paints a very different picture. Armchair statisticians constantly claim that affordability needs to improve due to mean reversion. This graphic definitively suggests that extremely low housing costs after the crash were the deviation, and that recent rise in home ownership costs was a mean to the reversion. So this is going back to 1987. This is your shelter index baseline going back to the 80s. We could go back even to the 70s, and it's going to be a baseline that looks something that goes around this spread rent inflation index. The problem with the crash in 2008, 9, 10, 11, that crash with the crash of interest rates pushed the affordability to a level that was never cheaper in history. So the cheapest time to buy a house was 2009, 10, 11, 12, 13, 14, 15, all through here. All through here was a gift to those that purchased a home because of cheap home prices and low interest rates. As the demographic and the population increased and more people wanted to buy homes, and as interest rates started to normalize, affordability went back to the long-term Fed rent inflation index. So what people are doing is they're comparing to the cheapest time in history to buy a home, and that's going all the way back, and comparing it to the cheapest time in history and saying, oh, well, it needs to come back to the cheapest time in history. No, it doesn't. It doesn't have to come back here, guys. And it may never get back there again in terms of affordability. And this is your medium income percent change US. We won't get into that data. The charts are pretty easy to look at. It says moving the baseline for both the mortgage cost and rent indices back to 1972 and showing the ratio between them, which is the more relevant metric because it is relative, it's illustrative. It places current affordability in context to modern history. So this is your rent index ratio, 1972 to 2024. So we had a very affordable time in the early 70s, the rent ratio, and this is another area. So these are basically the best times to purchase We're this area right where we were, and we're back in the early 1970s. The average is basically since 1972 is this dotted line, and we're back to the average. It says there are many versions of this chart floating around the internet, and most are complete BS. This one is real based on data from the Federal Reserve. Yes, the home price to income ratio has been in steady uptrend for 61 years, although right now it is below trend. So that is your house price income ratio. Median family income, median house price. And this is by quarter, moving back and forth in an uptrend. And we are below that trend line. Why has it trended up? Because interest rates have been in a general downtrend for the past 40 years, and lower interest rates translate to higher prices at a fixed mortgage payment. This is where all those protesting the Fed is pumping up asset prices with low rates chime in. They are wrong. Rising home prices is an effect of lower rates, but not the objective of them. The Fed has lowered rates as needed to stimulate sufficient investment to drive job growth up enough to send unemployment down. In other words, to promote maximum employment. The general bias for interest rates was down for 40 years because there was never a serious threat to price stability. They were free to lower rates as much as they needed to, and they did until 2022. Interest rates are targeted at job growth and unemployment, period. So that's his opinion there on the housing market. And I think it's a pretty valid opinion there. Michael Beaumart says, ask Grok to value monetary metals with reserves to equal the national debt. So if that were to equal the national debt, gold would be 201,415 per ounce, silver would be 13,428 per ounce, and platinum would be 201,415 per ounce. Do you guys like those numbers or not? That's if you were to revalue against the national debt. Dime Opinion says rent will go up 10%, health insurance will go up 10%, food will go up 15%, and car insurance will go up 20%. Then the government will tell you inflation is 2%. It's true, though. A lot of these health insurance is a disaster. SPY lost major support versus XLE, which is the energy ETF in 2022. What if the past 2 years was nothing more than a counter trend rally and that we drop again? That is exactly what I think it is. XLE will outperform the S&P 500, and we had a consolidation in XLE for the past 2 years. That is exactly what I think. 100%. If you own $16,000 worth of physical silver, that puts you in the top 1% of holders. Who's in the top 1%? I am definitely in the top 1% if $16,000 worth of physical silver is what you own. That would probably put me in the top 0.1% maybe. Jesse Colombo says the big banks slam silver practically every morning to keep its price low. Its price should be much higher than it is now, but I believe that manipulation is soon coming to an end. Learn more in my detailed report. These are the morning slams. You can see these big morning slams almost every day coming on out. It will end. Just wait for the physical metal to go short. Just like oil, I think oil over the next, couple of years is going to get shorter and shorter. And silver, these are physical items that get used and consumed in industry. So it's just a matter of being patient and waiting. Jenny Many Dots says a flurry of oil projects from Brazil to Saudi Arabia are set to come online this year, providing the biggest infusion of new crude production in more than a decade. And then they've got it projected at 3 million barrels. I don't believe that we're going to get 3 million. But it says global oil forecasters have been projecting a supply overhang for 2025 as countries, including Guyana and Brazil, bring on new output from OPEC Plus plans to start reviving idled output in April. Meanwhile, Trump's trade policies have fanned concerns about reducing global energy demand. While Raymond James didn't provide full forecast for production and consumption, the firm projects that supply will outstrip demand by 280,000 barrels a day toward the end of 2025. investors have not fully grasped just how much new supply from projects is on deck in 2025. I'm going to go over later on in this clip using artificial intelligence the oil supply demand characteristics, spare capacity, decline rates, and kind of do the oil thesis at the back end of this clip. Here's rotation so far. We've got a lot of stuff getting rotated in and improving. XLV, XLRE, XLP, XLE. XLE is energy. Some of these is materials, but they're all improving. Then we've got XLY, which is weakening. I don't even know what's XLY. Let me look. XLY doc. Consumer discretionary. Okay. Bob Coleman says, Gold futures alert. CME is raising margin rates on COMEX gold contracts by 8%. New rates effective as of March 21st, 2025. Silver's unchanged. As the price goes up, gold and silver, what you'll see is that they increase these margin rates. What that does is it slows down the move to the upside as people can't borrow or leverage as much in the markets. You'll see this all over the place very soon. They'll be raising these rates, and last time I saw a whole bunch in 2010, 2011 for silver specifically. And that's what I've got there. What I'm going to do is I'm going to switch over to Grok and show you guys what's going on with the oil thesis and market there. All right, so I'm going to dive into AI using Grok on Twitter to see kind of the oil thesis and test the oil thesis. So what we've been seeing in the commercial inventories around the world is a drawdown in inventories. Right now, if you were to use a dot plot to determine the fair value of oil, it would be $25 undervalued from the price today, roughly speaking. So why is oil down here? What's the cause of oil being $25 undervalued versus where we are today? What is the disconnect between the data that we're tracking on the inventory levels and spare capacity? Because that's where the mismatch is. It's in spare capacity. So what I did is I went back and I asked artificial intelligence, what was the spare oil capacity in 2004 during the last bull market? This is where oil prices escalated rapidly. And, just keep in mind that oil moves based off of the disconnect between inflation and supply constraints. So if you get supply constraints, your spare capacity will decline, pushing oil prices higher. So we're going to go back to the last bull market and see what the spare capacity was and look at the spare capacity to today. So in 2004, I'm going to kind of skip through some of this. So it says, while exact figures can vary depending on the source of methodology, estimates suggest that OPEC's spare capacity hovered around 1 to 2 million barrels per day for much of the year, with some periods dropping as low as 500,000 barrels per day. This was a significant decrease from previous years, driven by rising global oil demand, particularly from economic growth in countries like China and limited ability to quickly increase production. So in 2004, we had a spare capacity hovering around 1 to 2 million barrels per day for much of that year. And that was a big bull market for that time frame. I'm going to there we go. It says the U.S. Energy Information and other industries indicate that spare capacity in 2004 was often cited as being below 1 million barrels per day at its tightest points, a stark contrast to the more comfortable levels of 3 to 5 million barrels per day seen in the early 2000s. Non-OPEC producers were operating near full capacity, leaving OPEC and primarily Saudi Arabia as the main holders of spare capacity. This tightness contributed to oil price volatility, with prices rising as markets grew concerned about the limited buffer against potential supply disruptions. So during that time frame, for context, world oil production was 83 to 84 million barrels per day. We had a spare capacity representing roughly 1 to 2% of total output at best, a thin margin that heightened market sensitivity. That low spare capacity in 2004 was a key factor in pushing oil prices upward, eventually approaching $50 per barrel by year end, a significant increase from prior years. So what I asked is, how much oil spare capacity do we have now? So this is what their estimates are. So it says in late 2024, the International Energy Agency, and these guys continue to overstate production, keep in mind, estimated OPEC plus spare capacity at around 5.1 million barrels per day, with Saudi Arabia accounting for the lion's share. So the conventional thought today is that we have 5.1 million barrels per day of spare capacity in OPEC. Non-OPEC spare capacity is limited. With the U.S. being the primary contributor outside of OPEC Plus, U.S. production is near record highs, around 13.4 million barrels per day in early 2025 per EIA forecasts. But its ability to quickly ramp up further is constrained by logistics and investment cycles, likely adding only 0.5 to 1 million barrels per day in the short term. Countries like Iran and Venezuela have theoretical spare capacity, 1 to 2 million barrels per day combined, but U.S. sanctions severely limit their ability to bring it online rapidly. So if you add all of them together, global spare capacity as of now sits between 5.5 and 6.5 million barrels per day, with OPEC Plus holding most of it. However, this assumes no major disruptions, yada, 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 with that type of stuff there. It says the range reflects some uncertainty. Saudi Arabia's true maximum capacity is debated. Some analysts cap it at 11.5 million barrels per day, rather than 12 million barrels per day without new drilling, and overproduction by some OPEC Plus members occasionally erodes the official spare capacity figure. So I tried to get the Saudi Arabia production chart long term. I guess AI doesn't produce these charts. It only spits it out with verbiage. But my guess, if you were to hold me to a spare production figure, it's much less than what AI is telling us, in my opinion. Saudi Arabia, if you go back and look at their production figures, they've been able to hold maybe 10, 10 and a half, maybe 11 million barrels per day consistently. Everything else is surge capacity, and I don't think they can hold 12 million barrels for forever, for a long time. So I think there's less spare capacity there. So I kept going down. I talked about Gawar. Gawar is the largest field, and it has peaked. It used to produce 5.5 million barrels back in 1980. It's at 3.5, 4 million now, and that's definitely has peaked. So I'm coming down. I said, what is world oil decline rates? Because another portion of this is how fast can we eat through spare capacity, regardless of what the spare capacity is and how debatable that spare capacity is. How fast can we eat through it? So what they did is they took the International Energy Agency, the IEA, which is, and other authoritative sources estimate global average decline rates to be 4 to 6% per year. That's kind of what they've got. Post-peak fields, 8 to 10% per year without intervention. Unconventional oil, massive decline rates there, 30 to 50% in the first year, 10 to 15% annually thereafter. So what the IEA states is 4 to 6% per year. So that's on 102, 103 million barrels per day production, or a little bit more than that. You're looking at maybe 5 million barrels per day replacement. something on the lines of that. So then I went down and I said Chevron, it was ExxonMobil. It wasn't Chevron. So I couldn't find anything from Chevron. Then I said ExxonMobil projects a steeper natural decline in global oil production around 15% annually compared to the IEA's estimate of 8%. I'm getting this from Google, and then I'm putting it into AI. So it says Exxon's 15% decline claim. ExxonMobil's 2024 Global Outlook, released late 2024, asserts that oil production from existing fields declines at about 15% per year without new investment. This figure is a significant jump from earlier industry estimates and reflects their view of a shifting energy landscape. They attribute this steeper decline to the growing reliance on unconventional resources like U.S. shale oil from the Permian Basin or tight oil formations, where production drops off much faster than in traditional conventional fields. For example, shale wells often see first-year declines of 30 to 50%, sometimes even 70%, or stabilizing at 10 to 15% annually in later years. ExxonMobil argues that these short cycle, high decline assets make up a larger share of global supply than the overall decline rate accelerates. Their logic is straightforward. Without continuous drilling and capital injection, global oil supply would plummet by over 15 million barrels per day in the first year alone, they claim, leading to shortages and price spikes. This underpins their call for sustained investment, even as the world eyes an energy transition. They project oil demand holding above 100 million barrels per day through 2050, far higher than the IEA's net zero scenario of 24 million barrels per day, reinforcing their case that abandoning investment now would be disastrous. And this is the IEA's 8% estimate, pegged decline rates for post-peak fields at around 8 to 10% annually without intervention, with a global average for all fields closer to 4 to 6% when factoring in active management and new projects. Their 8% figure, often cited for natural decline, applies specifically to mature conventional fields, think North Sea and Gulf of Mexico, where geology allows slower depletion compared to shale. The IEA's lower average reflects a broader mix: long-lived OPEC giants 3 to 5% decline, aging non-OPEC fields 5 to 10%, and shale's steep drops. They've acknowledged shale's impact but haven't fully recalibrated their global baseline to ExxonMobil's 15%, likely because conventional fields, still 70% of supply, dominate their models. So we're looking at the models. So here's the downfall of artificial intelligence. AI, at least the way they're using it through Grok, grabs information, basically assimilates the information from existing areas, assuming that the information is correct. And then it will spit back what that information is. And what I'm seeing is a large discrepancy between, and I think it came from Chevron too, Chevron, ExxonMobil, and then also Goring and Rosenzweig and the models that they're using, which they're using artificial intelligence to aggregate up all of the data from the fields. The decline rate is a big deal because that spare capacity that people lean on, and then the decline rates that the IEA uses, which are all from old models back in conventional wells. If we use a higher decline rate, and I think the decline rate is probably around 8 to maybe 10%, somewhere in there, with investment. So ExxonMobil has a 15% decline rate without investment. With investment, it's probably 8 to 10%. So we can round it on a low, 105, 104 million barrels per day demand and supply right now. We would decline roughly 9 or 10 million barrels per day. That is in order to stay flat. If spare capacity is arguably somewhere in the range of 3.5 to 4.5 million barrels per day, well, that's only 6 months of production if you can't grow production somewhere else in non-OPEC areas. There is some growth in 2025 in non-OPEC areas like Brazil, Guyana. And that will help alleviate some of the decline rates. I don't think it will offset all of the decline rates. So we're going to have to eat into the spare capacity that OPEC has. Now, here's the big debate. The big debate here. So this is the IA historically pegged decline post fields at around 8 to 10. And that's what I'm using as it. And that's with intervention, not without. They're saying the fields are closer to 4 to 6. So the debate is there's two areas of debate here. How much spare capacity does the world actually have? And that debate, I would debate that we are closer to a few million barrels at best of steady capacity, not surge capacity. Surge capacity, we might have 4 million barrels or 5 million barrels. Steady capacity, I think we're looking at like 3 million, maybe. Then you look at decline rates, and there's the debate around decline rates. ExxonMobil and a lot of the insiders that are in America, so like Exxon, Chevron, Occidental Petroleum, they are stating that the decline rates are greater than 4 to 6%, that they're closer to maybe 8 to 10%. And that's with investment. If you take the 8 to 10% decline rates that I am using, which you could say is more aggressive, you look at spare capacity and you look at the growth and where it's coming from. Within the next few years, we are going to have a problem because the decline rates mean that you need to replace 8 to 10 million barrels per day that will come from OPEC. I'll just say OPEC, spare capacity, and production growth in non-OPEC areas. I don't think that we have 3 years worth of projects that can cover that decline rate. And I don't think shale can grow meaningfully to cover that gap, which that is what covered the gap the past 10 years, is large non-OPEC growth coming from shale in America. Now, is this a fact that I'm stating? No, it's not a fact. No one knows the actual numbers. And that's where things get real hairy, is what I'll call. We know that North Sea has peaked. We know that Gulf of Mexico's peaked, and they're coming down rapidly. There are other spots in the world that can grow production: Venezuela, Canada, offshore Guyana. Now, the question is, can that growth offset 8 to 10 million barrel per day decline rates per year? And that's where things get funky, because then you can expand your time horizon, your time frame, and say, well, in the next 5 years, all of that growth will be consumed definitely by decline rates. If the decline rates are 8 to 10%, if the decline rates are 5 million barrels per day, well, then that's probably still roughly would do it. 8 to 10 will just get you there faster. So a lot of it depends on if shale has peaked, and there are huge debates around that. And peak means that not just peaking, but just going sideways would be enough, where the natural decline rates around the world would be enough to put us into a deficit and eat through spare capacity. It needs to actually grow. And the only spot that's growing in shale has been the Permian Basin. And the Permian Basin looks like it is really slowing down its growth. So one can conclude, at least my conclusions, is that if shale oil from the Permian peaks here in the next couple of years, and we eat through any other spare capacity that OPEC has, and all of the new projects coming online from Guyana and Brazil are barely going to offset the decline rates over the next few years, then one could state that within the next 3, 4, 5 years, we could have a problem in oil. Now, markets are forward looking, and we don't know exactly what the spare capacity is of OPEC, and we don't know what the decline rates for surely are. So there's a lot of ambiguity in this setup here. And this is the discrepancy, at least what they're saying is ExxonMobil emphasizes the rising share of unconventional oil, and they are shifting their models more towards the decline rates of unconventional and applying that to the world, while the IEA is not. ExxonMobil's 15% appears to be a no investment scenario, pure natural decline, while the IEA's 8% often assumes some maintenance, infill, drilling, water injection. ExxonMobil's figure is a worst case. Yeah, so I was saying it's probably like 8 to 10%. That gets you the 8 to 10 million barrel decline rate with infill drilling and water injection. Says data and bias, ExxonMobil, a super major with heavy stakes in shale, Permian via Pioneer acquisition, may amplify decline rates to justify its upstream focus. The IEA tasked the Energy Security and Transition Advocacy might downplay the decline to avoid panic or over reliance on fossil fuels. Neither figure is wrong. They're framed differently. So I took the figure that goes between these two. And that's kind of where I'm at. It says ExxonMobil push for investment hinges on replacing this rapid decline. Shale's short cycle nature demands constant drilling, hundreds of new wells yearly just to hold U.S. output at 13 million barrels per day. Globally, offsetting a 15% decline on 100 million barrels would require 15 million barrels per day of new supply annually, equivalent to adding a new Russia every year. Unconventional plays, Permian, Bakken, Argentina's Vaca Muerta, are key because they're faster to develop than deep water or Arctic projects, but they're capital intensive and geologically infinite, or geologically finite, sorry. ExxonMobil's 2025 CapEx plan reflects this, prioritizing Permian growth while touting a 10% earnings CAGR through 2030. So we need a bunch of investment. I mean, that's basically what it comes down to hold production flat. If demand continues to rise and we get these decline rates, I think that we're going to hit problems within the next maybe couple years. So let's say 3 years. So 3 to 5 years, I'll give myself that window, and that's where the problem will become. Now, markets are forward looking. So if the problem is 3 years out, that's a big if, and the markets are forward looking by 18 months, that means that we might have a year and a half window. Maybe. That depends because there's a lot of ambiguity with all these numbers. We don't know the exact spare capacity, and they're not going to tell you what it is. They probably don't even know themselves. And then we don't know the natural decline rates. Some people who are more aggressive will say it's 10 million barrels per day per year. Others who are more conservative will say it's more like 5 million barrels per day per year. There are some projects coming on in 2025 that will keep potentially oil down for a little bit longer. We are coming into seasonality where oil demand increases during spring, summer months for summer driving season. So there is that in the background. And we are really cheap in terms of oil to gold ratios, inflation adjusted. We are cheap in relationship to high cost producers. We're underneath the high cost producers. So oil is not going to come online at this price either. So it's a good time to put on a trade, in my opinion, or an investment when the oil price is underneath the cost curve. It's cheap against other assets. It's a good time to put it on and then be patient enough to wait for the thesis to play out and to see what the world production will eventually play out. We're also in a commodity bull market where money could rotate out of financial assets toward hard assets, which will also further the investment and money flows coming into oil, which will support higher oil equity prices. So there's also that in the background, not just this, we'll call it sector fundamentals that are developing. But that's where I'm going to end it there, guys. Um, if Give me a thumb up for the content, and that's where we're going to end it. So that's all I've got for today. We'll catch you next time. This is Finding Value.